your time efficiently. Ready to go, Victor? Okay. So I'm going to share some research insights from a study that I did over a year ago, and the details of that particular study. It's called the 55 Greatest Winning Stocks from 2003 to 2020. And just as some background, why did I decide to do this study? The reason I did the study was actually I was going through some really old materials that I had from IBD, and this booklet I got from IBD way back in the, late 90s. And it was a book that Bill had put together as a little model book of the greatest winners from 62 to 77. And this was a quote that was kind of in that book. And I won't read the whole thing, but the second thing, part of the paragraph says, it's not necessarily a collection of the best companies or only quality blue chip growth stocks, but a collection of the stocks that produce the best results in the marketplace during various time periods over the last 15 years. A stock may have produced outstanding results for 1, 5, or maybe only 6 months, but history does repeat itself at many times and under many circumstances. The farther back one can see and understand, the more clearly should one be able to see ahead. That's what Bill had to say in 1977. So that inspired me to say, well, maybe I'll do my own model book. And I said, maybe I'll learn something, and I'll either learn a couple things. One is maybe I just reinforce some of the things that Bill talks about in his book. That's possible. But the other thing that was valuable about doing the study was to really look at these big winners, because they become future precedent stocks, future model book stocks. Past winning stocks can be the precedent and used wisely to identify and guide you with some decisions with future winners and help you. So those are the two reasons I did the study. So this slide shows this is all the components in this study. And there's way more than we could ever cover in an hour presentation today. But I did look at detailed breakouts. The blue is the first 8 weeks after initial breakout. And this is the part of the study I'm going to share with you in the next hour, all of the detail behind this. But I also studied the 10-week moving average action very carefully about rules and guidelines about what's a meaningful break and how does it work? How do these winners deal with the 10-week moving average? Then I studied the sell signals, all the sell signals of the big winners when they finally topped. And also very interestingly, I compared the results of this study to a couple other studies that me and a few colleagues in the Boston meetup site had done in prior years. So I'm going to share the blue part of the study today. So before we can really launch into that, what's important is, there's lots and lots of definitions to do the study. And actually, there's a couple pages of data guidelines, but the two that are going to be important for you to understand for this presentation is I'm going to talk about something called the initial run and the first pullback, which is defined in the study as the first correction measured from the intraday high to the intraday low that measures a minimum of 12%. So that's a key definition. And the second definition is how do we measure the run in a big winning stock. So the peak of the run definition is we will measure from the pivot day to the intraday high of the run. And there's two conditions. One, if a stock makes its all-time high and it declines 40% and has not traded at a new high within 6 months, then the run is considered over. If a stock declines less than 40% off its high and is not traded at a new high for 9 months, then the run is considered over and dead. So those are two definitions that we'll touch on as we go through this. So this is just a stock to give you some context. This is the NASDAQ composite. I'm showing 2003 to 2012, and I plotted the breakout dates for these greatest winning stocks. And the shaded area in yellow shows you where there were bear markets. And you'll notice that a number of these stocks are clustered near the beginning of bear market, coming out of the bear markets where there was a follow through day. There's the 2008 financial crisis. A bunch of stocks came out of that to become, very, very big winners. And here's the second half of the chart from 2012 to 2020. Again, big follow through day in 2012, bunch of leaders came out. Then a bear market, really I call it a stealth bear market in 2015, very challenging year. Again, coming out of that follow through day, you can see clusters of winning stocks. And you can see again the bear market in 2018 and the COVID bear market. So in doing all this data gathering, there's lots and lots of charts and data tables. So there's lots of data tables, but being an architect as I am, I usually like to translate these data tables into a more digestible pictures are what architects do. So a lot of these tables get turned into charts that really give us at our fingertips useful information. So the study, this is just an example of a page in the study. The study is organized by the winning stock, and I study the base. Every base is included in the study, and we really want to look at, in this case, we're going to look at the first 8 weeks. And then I've also included the topping of the stock, because I did study how did they top, what sell rules were generated when a stock topped. And the other thing is that we looked at is, this is an example showing really the entire run from the breakout and to where it topped. And then you'll notice along the way, I studied every single 10-week break of a big winning stock. And the gray ones are usually breaks of the 10-week that didn't break a series of rules that we have established. Say, don't sell here because it didn't break the rule. The red ones show where you would have sold because you triggered a sell rule. So every one of the stocks has a very detailed analysis on the 10-week, but we're not going to be going over that in detail today. So here's an index. These are the stocks. And you'll notice, the thing I'll note here is there's the ones in blue. The ones in blue, of which I think there are 6 in blue, those stocks, the run is not over. They are still going. So Atlassian, Five9, Okta, C Limited, Shopify, Vive, these stocks are still tending to have not topped according to the rules that I outlined at the beginning of the study. So I had put out this poll on Twitter about a month ago, and I said, well, using model stock rules, which one had the largest gain in this period of time? And the poll said 61% of the people said Domino's Pizza, and only 12% said Shopify. The actual biggest winner is Shopify, which is up 170% since its breakout in 2016. Interesting. So this is just one table, which is a very high level summary that shows these are the order of the winning stocks. And here's Shopify, and it goes, here's the breakout day gain, the breakout day volume, and then eventually the complete move in terms of when did it peak, how many weeks to the peak, months to the peak, what was the price, and what's the gain. So this is an example of a data table at a high level. So what's important is when we finally get to the bottom, and you look at this, you say, well, what was the average summary of the best of the best? Because these are really the strongest performing stocks. If you'll notice, the last one in the study is Zoom Video, and it was up 449%. So if you didn't make over 450%, you didn't even make this study. That shows you, and the median gain of these winning stocks in this period is 805% in 113 weeks as a medium. And we also have maxes and minimums in the study. So as I mentioned, the focus of this presentation is going to be studying this zone of these stocks. We're going to look at the prior uptrend. We're going to look at the base, and then very carefully look at what was happening in the first 8 weeks post-breakout, and what was this first 12% pullback telling us. Does it tell us anything about, do we have our hands on a big winning stock or not? So we're going to start with, we're going to do this in kind of chronological order over the evolution of this period of time. And so we're going to look at the prior uptrend. Whoops. So this bar chart is showing that in the study, 22 stocks had a minimum prior uptrend of 75% run up minimum. The average was 123% run up. So this is really important. Prior uptrends are very important to show that institutions are already buying your stock. They're moving it up. 40% of these best of the best had a huge uptrend before the big move. So they're already being accumulated by the institutions. You can look at the balance of the study, had about a 44% uptrend, still a great gain, but the ones that were up 100% or more is impressive. So this simple stat is really saying a couple of different things. One, you want to be fishing in a pond that's stocked with the big fish, and the saying that strength begets strength. Because, you know, sometimes you'll see a stock and it'll have already doubled, and you don't want to feel that you can't buy a stock that has doubled or tripled, because these stocks were up 100% before they went on these incredible big moves. So essentially, if you were afraid to buy a stock that had already run up 40%, you missed all the greatest winners from 2003 to 2020 in terms of catching the bulk of the move. So it's an important thing. It's not talked about probably nearly enough. You know, Bill says in his book, he wants to see a 25-30% uptrend before he's interested in the stock. And the reason is he wants to know that institutions have already begun to buy this winner before it creates a base that really is a launching pad. So let's go a little further into the bases themselves. So these are primarily the different types of bases in the study, and what kind of gain and what amount of time frame different patterns produced. So in the study, these are the median gain. So stocks that had formed a cup, they went up an average of median of 604% in 106 weeks. Flat bases, double bottoms, and IPOs. The classic cup with handle, 830% in 117 weeks. And consolidations actually was the greatest number of stocks that were up 857% in 111 weeks. So cup with handle and consolidation were the dominant ones in this particular study. So as we study the bases, the things that we really looked at, and this is just an example, again, a page from the study. This actually is Coupa software. So, you know, the base forms a cup with handle. We wanted to really capture what did the breakout day look like, the breakout day gain, its volume. And we studied a couple different things, really looked at the 10-day, the 20-day, and the 50-day moving averages to say, did they hold those moving averages? Did it mean anything? And also, we're looking for signs of real power. And I'm going to talk about ants in a little bit as it relates to a sign of real power in a stock. So we're trying to come up with what are the characteristics that were fairly common amongst some of the big leading stocks. And again, this is Coupa's longer term chart looking at all the 10-week breaks. Also looking at the bases along the way, et cetera, and eventually getting into some of the topping signals. So I want to talk about ants. Some of you are familiar with ants. For those that are not familiar with ants, I'll take the time to go through that. This was a term coined by David Ryan. David Ryan was a Bill O'Neill protege, 3-time US investing champion in the 1980s. And David, studied his own stocks and noticed that the biggest winning stocks tend to really sprint out of the gate. And what does that mean? Well, he studied the characteristic was you'll see a stock that makes a minimum of a 25% move over about 15 days, and you might see 12 or 15 up days in a row. And the important part also is the aggregate volume over the 15 days is a 20% increase over average. So David Ryan was at William O'Neill, and he programmed all the Wanda charts to put little triangles over the prices. And if a stock formed ant, you saw these little black triangles above the price action, which told you you were seeing signs of tremendous power. Now, the signs of very strong demand, there's two ways to look at it. There's at the beginning of the move, you can have ants, and I'll show some examples of where you can have ants in a base for the first 8 to 12 weeks. The other thing you can have ants is at the end of a move. You'll see ants in a climax run. So here's NVIDIA. And this is in February 2016. When you look at the base of NVIDIA, now within the base, they formed a cup with handle base. There was tremendous signs of accumulation. Even on the way down, as the market was selling off very hard, you'll notice that NVIDIA is always closing off the lows. Even on the daily bars, it's kind of always trying to close off the lows, showing, that it really doesn't want to go down. And then you'll notice on the right side of the chart, you've got multiple gaps. You've got a gap here, a huge gap in the base. These are very powerful gaps, and the volume is really pretty strong as it comes up the right side of the base as the follow-through day occurs in mid to late February. So if you look at this in more depth, this meets the criteria of it was up to 10 of 12 days, and it met the volume criteria. So it's showing really strong price action, strong volume action. This happens to be in the base, which is a really powerful characteristic before it even broke out. So here's a couple other examples to understand the concept. Here's AMD from 2019. You'll see right around the breakup, it had 3 very strong days. 2 days, the volume actually declined, and then a surge of volume as it pushed higher. And it had 13 of 15 days up, 30% gain in price, and it met the criteria of this aggregate volume during this was over 20% more than normal. Then this stock acts like a dream. It goes sideways, it goes very, very tight, the volume dries up, and then it actually has another set of ants that shows up 11 of 15 days, a 33% gain, and you can see the volume spikes. This is a tremendous power and just really ideal price and volume action. So it's an example of this ants concept. Now, ants, I mentioned at the end of a move, are something to be aware of, but it's not in a bullish way. It's more of a caution that a stock might be extended, or we're going to having a climax run. So here's Square in 2017. If you draw an upper channel line, the stock breaks the upper channel line and really goes up very powerfully into a climax run. You'll notice that this stock actually has 2 sets of ants. Now, this is interesting because it has a breakout, then it has a set of ants here, 14 days in a row up, 22% gain, the volume meets the criteria. But then as it makes the climax run, you have to recognize that this series of power, which again is up 10 of 11 days, 42% gain, and the volume is the biggest volume in the entire chart. This is happening at the end of a run. The big clue is you've exceeded an upper channel line, and the stock ultimately has a major reversal day on the biggest volume of the run. So ants are not so positive at the end of a run, but they are a good clue to maybe the last buyers are coming into the stock. So here's the meat of the study. This is probably what you want to know. 66% of the greatest winners showed ants. That's a lot. That's 2/3 of the study. Real sign of institutional demand. And if you take those stocks and you say, well, what was the average gain? The average gain was 38% on a 62% increase in volume over the 15-year or 15-day period. And if you took those stocks, they actually had an average gain to the peak of over 1,000%. So they demonstrated, really superior power. I also looked at relative strength, and this particular data table is looking at, you can see here, this is the base data. This is the post-breakout thrust, which really is looking at ants. and then the breakout data. And then this column is saying, did the relative strength line go to new highs before price? And there were 25 names in this study where the relative strength line led the price action at the breakout. And when you see the relative strength line go up into new high ground before price, that's very, very bullish. The question is, how did those 25 stocks ultimately perform? So the relative strength line at new high, the average gain was 916% in 130 weeks. The entire study was 1,042 in 138 weeks, and the median is very close. So when you really get into this, it's, we look at this as a nice timing mechanism. I think that's a really great sign. It's a very positive sign in terms of timing that your stock is starting to show relative strength, but we didn't really find a meaningful correlation in terms of the ultimate gain to the peak. So it was interesting because, you didn't say if you went into relative strength line new high, oh my God, those stocks did twice as good. It wasn't the case, no meaningful correlation, but still a very positive sign. And as I mentioned, there were almost half the study had that characteristic. So it's a positive characteristic to look for. Okay, so let's look at this third component of getting out of the gate. And that's really the study of the first 8 weeks post-breakout. So what this graphic is trying to show is this kind of 8-week move, the post-breakout. What happened during the first 8 weeks after a breakout? And I used the 10-day simple moving average, which is shown here in green, the 21-day exponential, and the 50-day simple moving average. And so these bars are showing you all of these stocks held the 10-day moving average the entire 8 weeks coming out of the gate. And here are the names of those stocks. And then their average gain was over 1,300%. Stocks that actually held the 21-day EMA, bigger group of stocks, and they also had outperformance. And then the ones that held the 50-day are here, and they also were over 800%, but not nearly as much as the performance you got out of stocks that were showing the characteristics of holding the 10-day for the first 8 weeks out of the gate. So I'll take you through this gradually. I know it's a lot of information, so we'll go slow. 44% of the greatest winners in this study triggered Bill's 8-week hold rule. Okay, and I put out a Twitter. I asked people. I said, what percent of these greatest winners do you think hit Bill's 8-week hold rule? And the poll said 37%. 37% people said it was 37%. Turns out it's 44% that actually triggered the 8-week hold rule. So the question is, well, what happens next? What happens next for these types of stocks? So if we look at this chart, we have a base and we break out. And the 8-week hold rule tells us that in the first 3 weeks, we have a minimum gain in 3 weeks or less from an early stage base. It's going to trigger Bill's 8-week hold rule. And the 8-week hold rule says, hold the stock for a minimum of 8 weeks. And when you get to the 8-week mark, you will reevaluate what to do with the position. So in this blue zone that I've drawn, this is weeks, after week 3 to week 8. Now there's 3 things I looked at very closely in analyzing what's happening between weeks 3 and 8. The green line says that after a stock comes out strong, it could, and the green line says we're going to digest our gains and kind of go sideways. And then after we've digested the gains, maybe the stock continues. So that's green, stocks that digest gains with little pullback. The second grouping is stocks that actually come back, shake down towards the pivot area, And then what happens to them? Do they recover from the pivot area and then go back up? And the third category is shakeouts. Which stocks, how many of the stocks that actually had the 8-week hold rule actually round tripped, broke the pivot, but turned around and continued higher? So those are three conditions that I looked at to try and understand what I could learn. So there were 14 stocks that had a digestion after the 8-week hold rule. And after 8 weeks, they were up an average of 79%. There were 7 names that returned to the pivot, and after 8 weeks, were up 54%. And there were 3 names that actually came and actually had a violent type of shakeout below the pivot, and they still, at the 8-week mark, they were actually still up 26%. So you might say, well, where did they go? Well, they ultimately, after the 8-week mark, believe it or not, the ones that digested gains, they went on to, at the peak, they had an average gain of 898% in 80 weeks. The blue, which was the ones that returned to the pivot, and we know from Bill's teachings that approximately 40% of stocks are going to return to the pivot. Those stocks went on for actually the biggest median gain of 1,006% in 85 weeks. And even the stocks that had a shakeout, they did continue higher, and they reached a median gain of 704% in 99 weeks. So let's look a little further at these stocks getting out of the gate in terms of the first 12% pullback. I know the reason I studied why did I use 12%? That's something that I picked up at one of the advanced workshops at Can Slim, where they talked about that William O'Neill, they used the 12% mark as really the first intermediate correction in a big winter. So that's really the first, I'll say, substantial correction in a winter. And everybody wants to study, well, what happens? When does that happen? How does it happen? And what does it ultimately mean? So that's the reason I used 12% was not random. It really comes out of a methodology that's how William O'Neill and Company studies model book stocks. So I call this the breakout run statistics. And this is taking a lot of data tables and trying to summarize them graphically. So you might say the breakout run is from the pivot, how far do we run up to the intraday peak before we have the 12% correction? So, and what kind of move did you get? Well, the average move in this study was a 62% move before you had a 12% correction. The median was 43%, and then this was the minimum and maximum moves before a 12% correction. And then you might naturally say, well, how long did it take? So if you took the number of days that breakout move occurred, average of about 49 days, median of 32 days. And what was the first pullback like? So the minimum pullback was 12%, and there's certain stocks that hit that minimum. But the average pullback of the whole study was about an 18% pullback, a median of 17%. And Monster Beverage actually pulled back 39%. That was the largest one. And then this bar is showing, well, how many days did the pullback take? If we're going to correct 12%, was it sharp or was it very, very gradual? The median was 10 days, 2 weeks, and the average was 13 days. And in one case, Fiverr from last year, it was in 1 day. And Domino's Pizza was a very gradual pullback of 12%. And then I looked at how many days did it take these stocks to actually reach a 25% gain coming out of the gate. And the median was 34 days. and 37 days on average. So those are the statistics off of the entire study. And then I went one step further and I really started to look at the top stocks in the study. And when you look at the top 10 stocks in the study and this 12% pullback, the way you read this chart is the blue is the gain, the breakout day initial run. So in this case, SHOP made a 44% gain. And the gray shows when it had its first 12% pullback, it pulled back 14%. The star represents that it held the 21-day moving average in the first 8 weeks of the move. And if you see striped blue bars, that means it actually triggered the 8-week hold rule. So it's interesting that 91% of the stocks in the study had a run of at least 25% before it ever had an intermediate correction. You can see some of these are quite large in terms of the moves before it had a major correction. These are big winning stocks over the last 10 to 15 years. And also, we talk about the 21-day average, and IBD talks about this a lot, that the 21-day is kind of a demarcation to say things are very strong in the market and growth stocks work pretty well when they're above the 21-day moving average. 68% of the stocks in the study that held the 21-day for the first 8 weeks. So it's kind of confirming some of the 21-day average material. I'm going to break there for a second. Is there anything we should talk about in the Q&A, Victor, at this point?
Yes, there are a couple of questions. So first of all, how long was the prior uptrend that you considered for the study?
How long was it?
Yeah.
I studied the gains to the peak, and then I went back and said, well, did it have a prior uptrend, and what was that prior uptrend?
Gotcha.
So I didn't draw a cutoff. There are stocks, like I said, that there was no minimum to make the study. The minimum was you had to have a gain to the peak of at least 449% or more, it turned out. But then I went backwards and I said, well, what was the prior uptrend of these 55 stocks? And then we calculated it and said, geez, there was really strong uptrends.
Gotcha. Okay. Excuse me. How many failed breakouts did you have?
I don't know that number. I didn't catalog that number. There were some that, closed below the pivot and they had to recover and had that shakeout situation, but I don't know off the top of my head what that is.
And I guess same thing here, that you don't know how many stocks made it back above the pivot after they went down after the initial run.
Right.
Gotcha.
Right.
All right. For now, we can continue going.
Okay. So, two previous market cycles, Mike Kincaid and Aaron Blank from the Boston meetup, we did two different market cycle studies. And we studied the 2012 to 2015 cycle of the greatest winners. And then we also studied the 2016 to 2018 winning stocks together. So, I naturally said, geez, I'd love to compare the data of the greatest winners to some of the stocks in these two studies to see if there's anything divergent, anything that is reinforcing some of the characteristics. So the gray bars are the previous studies, and the blue is obviously we're talking about this study. These are the best of the best. So we expect their bars to be very high. So this is, gain to the peak. So, the average gain to the peak is over 1,000% for this study. But the 2016 to 2018, the average gain to the peak was 357%. And the 2012 to 2015 had an average of 332. So these two studies, the big winners, they kind of were in this 300 to 350 average gain. Obviously, this is an outlier because we're taking the best of the best. And the question about time, how long did it take to get there? You'll notice that in these two prior studies, generally around 90 to 100 weeks, which is, EBD talks about model book stocks typically have runs between 18 months and 22 months. So this is kind of in the same general realm, though these stocks went on for much, a little longer runs than that. Some of them are, like I said, are really long, but the averages are not that different. They're about 2 years in terms of the averages and the median runs. So from there, I tried to develop a template to try and graphically capture some of this information. And this was my attempt to do that in terms of power from the breakout, getting out of the gate. So what we learned was the median run-up, prior uptrend of the whole study was 62%, pretty good size run-up. And the median depth of all the bases of these stocks was about 30%. And when you take all the breakouts and you say, what was the characteristic? The average breakout day gain was 11% on a volume percent increase of 426% above average, big volume, okay? Then as the move gets out of the gate, I did look at checking the 8-week hold rule, and I shared with you some of the things around the 8-week hold rule. And then we talked about this initial breakout run. How far does it go before we start to get the first pullback? Well, the study shows that this run from breakout before we start to correct into a 12% correction is a median of 43% in 6.5 weeks before we start pulling back. And the median pullback was 17% pullback that occurred over 10 days. And then I also studied, well, how far did the stock go between bases? Like how far did it go between this base and the next base, this next phase 2 base? In this particular study, the stocks were up 111% before they ever formed a stage 2 base. So these stocks are very, very strong characteristics coming out of the gate. So I looked at these numbers and I said, well, how does this compare with some other model book stock data that we have? So I lined them up. The orange is the 2015 study, then the 2018 study, and then this greatest model book. And I've picked off a series of things from the data tables. Again, initial gain from the breakout, the length of the run, the percent pullback, the length of the pullback, and ultimately how much did it gain to the peak. Now, what I think is really, really interesting is look at the pullback after the breakout, almost identical in every study. And these are big winning stocks. And look at the length, the median length of the pullback in days. It's almost identical, less in the super winning stocks. But this I thought was very, very interesting information to have going forward. The 2018 study had an ultimate gain to the peak of 342. So if you were to translate some of this to this graphic that I've created, essentially if you have a breakout, let's use the number, you break out at 100, and we have this initial run up. In this case, the 2018 model book ran up 33%. So you'd be at a price of 133. And then the stock would go into its first pullback. And from this data across 3 different model books, 16%, and it's going to occur over, in this case, over about 3 weeks. So that means the stock's going to go from 133 back down to 111 over a 3-week period. Okay. And then it will continue on this and go on to make this, in this case, a 342% gain, which is somewhere around 440. So why is this important? I think this data is really important because it's starting to show some consistency across model book periods. And it's important because it sets expectations for what is normal and abnormal. If you know from data, a big stock comes out strong, you can expect it's going to have a 15, 16, 17% pullback in over 2 to 3 weeks. And it would still be considered normal, and it might help you stay in a potential big winning stock. Now, if we translate this back, you know, Bill's 8-week hold rule is designed to do just that. The strong stocks come out, they go up 20% in 3 weeks. And Bill says, you got to hold them for 8 weeks. And I believe that the reason he has that rule is he's trying to force you to stay into that stock during the first pullback, which could be sharp, but happen rapidly over 2 to 3 weeks. But if the stock really has accumulation, it's going to come out of it and go higher. Hence the 8-week hold rule for a stock coming out of, I'll say, an early base and meeting all the other characteristics that go along with the 8-week hold rule. So I think this is, to me, this is very, very useful and very helpful information, because we're always trying to say, you know, is this normal that it came all the way back this way? Is this weakness? And this may help you with some expectations. So let me go back now and just kind of summarize, and then we'll open it up for some more questions. The bases, the prior uptrends were in that 68% range in the median. Prior uptrends are very, very important. Strong prior uptrends tend to outperform in the next rally. So don't be fearful of buying a stock because it's already doubled in price. Sometimes those are your best watch list candidates early in a bull market. And I'll emphasize that, early in a bull market. Median base was 14 weeks deep, 30% deep, and 47% of these greatest winners were cup with handles patterns. And I shared some of the results of the other patterns. 93% of the greatest winners broke out of early stage bases. They were either IPO, stage 1, or stage 2, confirming what we probably already know. 54% returned to revisit or shake out down to the pivot. So you have to be patient, and it might mean you have to buy it back. If it undercuts the pivot and you sell, you have to be willing to consider buying back. And 91% of really powerful winners had the initial breakout run of 20% before they ever had that first 12% pullback. So 20% of the greatest winners held their 10-day moving average for the first 8 weeks. So it's not that many. So it's not, I would not get worried if your stock breaks the 10-day in that first 8-week period. Not even the greatest winners held that. Only 20% held that. But 67, 2/3 of the study held the 21-day. That's kind of more meaningful. And again, 91% had their initial breakout run before a pullback. And this was that stat that we just looked at. I think it's important to know that you can expect that first pullback to be about 16 to 17%. And these greatest winners, it was over 10 days. The other studies were, I think, 16 or 17 days. But pretty interesting information. So it's a lot of data here. So, you know, what we just covered was, you know, this block of information from the study. I mean, I didn't share every data table with you, but I shared more of just the summary graphics because I think they're a little easier to understand. One part of the study, there are still 3 to 4 more parts of the study that go into a lot of detail about 10-week action, sell signals, what did the bases look like in great detail, and more comparing it to other model book cycles. But I wanted to share at least one part of the study with you. If you have an interest in the full study, it's 100 pages, it's color, it's indexed, it has 55 annotated charts that show all the characteristics, has all the actual data tables about breakouts, first week pullbacks, all the analysis of that, benchmarks to previous cycles, the graphics. I'd like to know if anybody is interested in that. So I've set up an email, and take a picture of this slide or write this down. If you're interested in getting the full study, send an email to 55greatestwinners@gmail.com before next Wednesday. And tell me if you're interested in seeing the book in an 11 by 17 format, 8.5 by 11 format, or if you want both formats. And also tell me the country for mailing address. We have people on this call from Australia, China, Europe, United States, because I'll get a level of initial interest here, and I'll have to get some pricing about what it's going to cost to print this book, ship this book, depends on the country, and the price of the study itself. So I will get all that information once I know there's a level of interest. And then I will send an email to all the interested people. I'll give you all the detailed information, and you can decide if it's something, something you want to buy or not. It's up to you. But I need to know the level of interest to see if this is worth, a printing. If we do this, anybody who does get the study, I'll have a group Zoom call with anybody who gets the study. We can do questions and answers and go into detail about anything you want to see in the study. There's quite a bit of information if you're interested. So that's my presentation, and open to taking questions on any of it.
So guys, we have a little bit more time right now. For those of you who have questions, please unmute yourself. You can easily just move the cursor, and bottom left, there's going to be a mute button. So just click on that and you can ask a question, please.
How do you find the breakout? What really indicates the breakout point?
What indicates that you're coming out of a base? I had to be coming out of a base.
Okay, yeah, thank you.
Can you explain the 8-week?
I didn't hear that.
Can you explain you said about one chart, it shows like a yellow shading and other different shading. Which one is the 8-week period you're talking about? Can you explain it?
I'm not sure. The 8-week hold rule?
Yeah. Yeah, here.
This?
No, next. Next. Here. Next, I think. Yeah, here. Where does the 8-week rule fits here?
Well, this is a graphic saying if a stock breaks out of, in this case, a cup with handle, and I was using the green model book study for this example, saying the stock moves up, and I think I used 33% because that was the initial median gain for that particular study. And that breakout, this particular gain, took 44 days. So 44 days divided by 5, that happens to be 9 weeks before it got there. And then it showed 16% pullback over 17 days. And ultimately, they went on to gain a total of 342.
Thank you.
John, 2 slides before that, when you had the patterns after the base breakout. Yes, this one. Did any of them violate the 8% rule?
Yeah, I think there were. Somebody asked if I knew the exact number. I don't, but frankly, you could find it. You could calculate it. I've got every single base in this book, so we could find it and do it. But there were some. In this case, the ones that triggered Bill's 8-week hold rule, there were 24 names. 3 of them did violate the pivot, but they came back.
But they didn't violate the 8% sell rule.
They might have. I had to look at it.
Okay.
They might have. They might have.
Because I'm just thinking if I hold it and
you
if
might
I
have been
get
shaken out.
Yeah, I would be shaken out. Okay, thank you.
John, did you, for your study, did you consider minimal liquidity requirement?
I did, and I do have it in the data guidelines, and that's always a careful thing, because one of the things I looked at is some of these when I was going through old IBD yearly the biggest winners, at the end of the year, IBD says, here's the greatest winners for this particular. And I actually thank Steve Sweats, because he'll remember about 2 years ago, I said, Steve, you got those old newspapers? Because I want to see those things, because that's a starting point for my study. So I found the stocks that, IBD said, these are the greatest winners. And then I look at those and I'm saying, IBD in their workshop says, oh yeah, this is a model book stock and that's a model book stock. And I was trying to say, well, what's the liquidity requirement before you count the base to start the study? Because a couple of them, they're model book stocks, but I had to temper that the liquidity was so, it was only like, 1 or 2 million. I said, I'm not going to use that for the study. I'm not going to count that as the start of the run. I generally tried to get it to be at least 5 million, and it needed to get up to, I think, 10 million within the first 3 months.
Okay, thank you. A follow-up question. In the beginning, you showed the slides. You said some of the winners, they're still going. Some of
Yes.
them are already done. How did you make a determination if the winner is already done or ongoing? For example, like when NVIDIA, had a 55% drawdown in October 2018, from October 2018 to, in 2 months, had a 55% drawdown, then came back like in 2019. So at that
Here it
time, if
is.
you did a study, you
Here
look
it
at the
is.
stock as a 55% drawdown. Do you consider that's done? That's over?
No,
Or
here's the definition on the screen. Look at the screen. This is a key definition in the study. If a stock declines over 40%, and you said NVIDIA corrected 55%, basically, as soon as it goes over 40%, it's got 6 months to hit a new high. And if it can't get itself back to new highs in 6 months, it's over. If its stock has a more gentle pullback, less than 40%, it's given more leeway, and it has 9 months to hit a new high. And I think I have the NVIDIA chart here. NVIDIA did break the 40% rule, and it did not hit a new high within 6 months, and that was when the run is considered over.
Okay, thank you.
Yeah, that's how this definition helps stay objective, I'll say. And I know that this definition, I heard Mike Webster talk about this kind of definition at a advanced workshop relative to model book stocks. So again, I use that because I said, I think this is how IBD would look at it.
Well, how did you determine with 6 months? Why not 9 months? Because there are a lot of true market leaders in the past, like Apple or Amazon, they all had like more than 40% correction. I know Apple didn't come back, they had 2012 September hit the peak, then didn't come back for almost 2 years. So
That's right. That's right.
Yeah.
As I said, this definition is from Mike Webster's lips.
Okay.
Okay. So when I say, why did I use 6 months, not 8 months, 9 months, 12 months, I had to come up with some line, and I felt that if it was good enough for IBD, I was going to use it for my study.
Okay. So basically there are some market leaders, they come back multiple times. It's possible.
Yes, you're exactly. Actually, believe it or not, in the study, I do have one of the runs for Apple in the study. And then there was a second run for Apple, as you know, that didn't meet the 450% gain, but I included the chart because I put the chart in the study because it's such a great learning model book stock. So I included both Apple runs in this book.
Okay, thanks.
Is that why there's 2 Tesla runs?
Yes, there's 2 Tesla runs in this particular book as well. So people wanted that slide with the email. There it is. So this,
Then we have a couple of
email me,
questions.
use this email if you're just telling me you have an interest, and please tell me if you're interested in what format or both, or if you want. And I think somebody asked, is there going to be a PDF I want electronically? I'm not producing electronics of the study. No electronic file.
Can I ask a question, John?
Yes.
So you identified 6 or 8 stocks. So they still, the condition still fits right now?
The 6 or 8 still running?
Yeah, like a Shopify, Viva, still there in that bull phase?
Yes, actually, I think I noted it here. I actually updated this study right here. I updated the data tables through September 3rd. So the data, those 6 stocks that are still running, was as of September 3rd of 2021. I went back the past month and I updated all the tables for those stocks that were still running. So they're pretty current, and
Oh,
they are
okay.
still running.
So based on that criteria, do you have anything in the, like, for example, recent ones like Upstart, Asana, Docs, any insights?
No, you have to, in this particular study, I ran the study from January of 2020 through December of 2020. And it turned out that the cutoff, if a stock wasn't up 450%, it didn't make the study. I had to stop at some point. Though, what I think would be a great thing to do is the next model book to do is the bull market that started in April 2020. And you would do a study like this, capturing all of these great winners, Zoom and Upstart and Asana and Net and all these stocks. And this is the next bull market cycle to do such a study.
Thank you.
Hey, John, is this book going to be a weekly charts or the daily plus weekly and monthly, or just daily?
It's, I'll show you the example. Essentially, the charts are every chart, this would be a great example. There's a full page that'll show you the base for all these stocks and has characteristics that were happening at the base and how it related to the moving averages. You will see a snapshot. Again, these are daily charts on the top and the base. So this is included for every stock. It also shows you the symbol and what was their gain in weeks. And then I include a weekly chart that shows the whole move. And this is the whole move for the same stock, CME, and it shows the whole move for this stock. And in this case, it really looks at studying every 10-week break. And I go over what the rules are for a 10-week break. This is the top. LL, it means it's 3 lower lows. It's a thing I studied also as part of the weekly charts. So all this, so each stock you're getting a weekly chart of the whole move, and you're going to get the base and top in a daily chart, all annotated.
Thank you. This is very good.
And these are the 6 stocks that are still alive.
John, could you talk a little bit about why you sometimes use an average and sometimes you use a median? What drives that selection of evaluation?
Working with Mike and Aaron when we did the previous market cycles, that was the way we set it up. We wanted to see the median, because sometimes when you're doing some of these subset studies, you'll say, well, geez, this subset is only 5 stocks. And you'll say, if I took the average, it just distorts things. So you say, we should always capture the median as well as the average, because sometimes it's very close. But sometimes when you're doing a subset that you're studying, it makes a sense to have a distinction between the two. So they're all the data includes medians, averages, and high-low. The highest one in a category, the lowest two.
Okay.
John, I'll make a comment on that one. I kind of prefer medians because as you all know, the problem with an average is that it's distorted by outliers, whether they be high outliers or low outliers. But then when you present both the average and the median, it will tell you if the average and the median are close, it means that in that distribution of numbers, there aren't a lot of outliers. If they're far apart, it means the average is being distorted by the outliers. The median is just a really safe statistic because half of the data is above it and half of the data is below it, no matter what.
The median is the 50 above, 50 below, yeah.
Is it just the charts, or do you have your data tables in there also?
All the data tables are in there too. This is just an example, but they cover the whole page. There's a lot of data. But this is like I told you, I think I showed some snippets along the way. You'll get all the data tables as well. Things like, well, this is a summary of one, but there's a lot of different tables that I showed along the way. But they're all in the study. Like here's a subset when I looked at the relative strength. You can see there's the blue stocks that are still alive.
So John, for your study, did you consider the fundamentals, whether it's like a retail, household name, life-changing? So those.
Yeah, I did not, because I don't have the ability to go back to capture the fundamentals, because some of these stocks, frankly, I had to go track down charts from 2003 and 4, and some of these stocks are out of business. So I don't have the fundamental data to go along with these, but I think when you look at the names, when you see names like Netflix and Square and Tesla, you know as well as I do, these stocks had real fundamental drivers behind them. Many of them had very high-flying stories. Some of them are a little under the radar, but I don't have the fundamental side of the story because I had to go backwards and I couldn't get that information.
Okay, thank you.
Hey, John, I have two quick questions. So the first question is that in this page, you are mentioning the first column is the prior uptrend. So like say this one's 50%, like how long are you looking back for that 50%? Is that within 1 year or something?
No, well, once we identify the liquidity requirements and we find the first base that is a valid liquidity requirement, we got that first base and we say this stock broke out on this date, then I would say from this date, what was the prior uptrend leading into this breakout? Was there a prior uptrend? And what was it? And we'll measure backwards from the low to the left side high of the base. In this case, Tesla had a 50% move from the low to the left high of the base before it formed a base. In this case, the base was 13 weeks, 21% deep. The left side of the base was 5 weeks. The right side of the base was 8 weeks. Then I have a base depth ratio. What stage was it in? What pattern was it in? Did it form ants? So all this kind of data is there. And
yeah, is that 50% like from the bottom of the base until like the breakout, or like just before the base form?
The prior uptrend is before the base forms.
Yes. So I'm wondering like how would you like define the start of the prior uptrend?
Yeah. So here, let's just say this is the base that we got our breakout. Okay. So this point right here, which is the high of the left side of the base, if I were to continue this, let's say this chart went down and it started here to turn right up, this low to this high of the left side of the base, that's the prior uptrend.
Got it. So you will just look back until like it's at the bottom and then how far it could go up until the base. Okay, thank you, thank you. Another quick question I have is for the RS line. So are you looking for the RS line in your chart? Are you looking at the 12 months RS line or 3 months RS line or something else?
I'm looking at the standard RS line that MarketSmith carries. So I think it's a 12-month RS line in MarketSmith.
Okay, got it. Thank you so much.
Yeah, thank you.
Hey, John, this is Lee. I have a question regarding the market cycle. So have you studied market cycle versus breakout timing? For example, did you notice any correlation between the breakout time versus late cycle breakout or early cycle breakout?
In this study?
Yeah.
Yeah, I think when I went back to the beginning here, when I plotted where did these great runs start, I do think it's interesting to note that many of them occurred after bear markets. There was a follow-through day, and you can see here, E-Research, CME. These are stocks breaking out that went on to big runs. Don't forget 2004. You can see this just shows you where they're breaking out. You can see here, here's the 2009 market. Look at all the stocks coming out of this bear market that went on to be some of the greatest winners. There's a lot of other winners in here, don't forget, that didn't go up 450%. Doesn't mean they're not big winners. They went up 100%, 200%, 300%. So this study, don't forget, this is the best of the best. You can see here, coming out of the 2015, which I call a stealth bear market. This is really basically Brexit. Essentially, this is the Brexit timeframe. We had a follow-through day, and look at the number of stocks that broke out, and we had a beautiful smooth uptrend throughout 2017. And look at the cluster of some of the all-time winners. And then we've got the 28 break with some stocks that broke out. And here's COVID, to capture the ones that made the study were Zoom, Fiverr, Neo, Tesla, that captured it. But they come out of a lot of these. That's why corrections and bear markets, you want to stay engaged with the market, because that's where the new leaders generally get formed.
John.
So you're
Thank you.
saying even it's a late breakouts, it doesn't mean it can go higher, right? Do you notice any, if, for example, early breakouts in the cycle, they tend to go higher or faster than the later breakouts? Have you noticed that relationship?
Yes,
Correlation?
actually, I think I noted it in my statistics that, let me see here if I can find it for you, because I think I showed this. On the summary stats, %93 of the breakouts of these greatest winners were early stage bases. They were stage 1 or 2. So that means 7% of the greatest winners were stage 3, 4, or 5. So it's a rare bird that breaks out of a stage 3, 4, or 5 and has this kind of move.
Okay, all right, thanks.
It's a great presentation. Thank you. Yeah.
You're
Thank you,
welcome.
John.
Thank you.
Great presentation. I just want to find out, like, how do we find out the new winners? So these are already, past winners. It's great data. So how do we find the new ones? Like, what is the criteria to check? In the screener, or where do you check that?
A simple question, John.
Yeah,
Why
that's a
can't you
simple
answer
question.
it?
Simple question. Tell me the next group of greatest winning stocks.
That's a great one.
Yeah, come on, John. It should spit it out like this.
We could take all night. I think it's, you got to do your screens. You got to do your homework. You got to do your screens. You got to do, study the patterns. You got to find your entries. You got to know the story. It's not about just patterns. You got to know the story. Does this stock have big accelerating sales and possibly big earnings and big product? And are they the leading stock in the group? And all of that, fundamentals plus the technicals, are key to trying to find the biggest leader. There's no guarantee, but you want to put the odds in your favor.
Thank you.
So what are
Yeah, if you've got a simpler way, let us know.
Okay.
All right, John, what do you want to do? You want to transition to the power picks?
Yeah, let's do that. Let's go to the power picks.
Before you start, so let me just stop the recording for a second so we can save it.